We wanted to speak to an accountant and understand what are some of the things we need to be thinking about when we're buying our first investment property. Even before we buy our property, what do we need to think about? And then when we have that property, how do we now scale it? How should we future think and future plan for the next 1, 2, 3, 4 acquisitions? And then, okay, great. We have these portfolios. We've had them for 5, 10, 15, 20. We're now looking to transition into that next phase. And what are the stumbling points? And this week we have Robbie Morris. He's from a company called Save Our Budget, which is all about understanding, these things in property investing and across the board for other asset classes, which we dive into. We talk about silver. We talk about gold. We talk about alternative assets. But this week is all about understanding, because he is a chartered accountant, where do people get stuck? And how can we overcome those things as a property investor to continue building the portfolio? So it's an interesting one. Hey, everyone, if you don't know who I am, I'm Joe Tucker. Together with Jeff Miles, we're created Oz Property Investors. It's Australia's largest property investment community. We've got over 85,000 members, and each week we interview top property experts. We've created the Level Up Property course so that everyone can go out there and learn how to buy investment-grade properties in investment-grade locations to build an amazing portfolio. But this session is all about how an accountant would go out there and start his portfolio, get to the middle, and then overcome it. Let's go.
And we are live on Oz Property Investors. We bring the big names and we bring the big Liverpool fun. I've destroyed it, and I'm a Man U fan, but it is a huge session. I've just destroyed that intro, but that's okay. We're going to talk about how are we building and scaling that portfolio, because for me, it's like becoming from beginner to winner. Everybody has to start somewhere, and we're all also going to have the advanced tactics on the trusts and all of the structuring and how to optimize all those scenarios. So lots of fun and lots of adventure in this session with Robbie, Mr. Robbie Morris, Robbie CA. Maybe I shouldn't be calling, sorry, Robbie CA.
Yeah, that's just the chartered accountant coming through. So thanks, guys. Thanks for having me. Looks like I need to work on my background a bit to look like Joe's next time. Very professional.
Yeah, no comment on mine. So you're doing really well. But no, thanks for coming along, Robbie, and Joe. How are you going as well? What's happening,
mate? I'm good. I'm fantastic. I just recently, actually, if you really want to know, I just recently purchased a car. One of my dream car of mine. And
I'm glad you're buying a car, not a bike. Good, thank goodness.
Well, this is how I got my dream car, was telling the wife that I will sell the motorcycles to swap it in for a car. Anyway,
wow.
How does this relate? It's a Lotus 7. Anyone that knows, it's kind of like anyone that knows Caterham. Robbie, looks like you know something about the UK. So they have a fantastic car called a Caterham, which is based off a Lotus 7. It is a very cool looking car. But I took a page out of the property negotiation book on it. And one of my favorite things to ask real estate agents is kind of like, I mean, you ask the question of like, okay, great, we're getting down to the nitty gritty on price. And this guy's like, no, it's 28, it's X dollars. And I'm like, yeah, okay, great. Well, look, I mean, we found all of these, I found all these little issues and things. And do you want me to go in low and you beat me up, or do you want me to just come in with my best and final? Like, which one do you want? And he's like, well, look, I'm a reasonable guy. I'm like, yeah, I mean, so am I. So that's why I'm like, which one do you want to do? That's why I kind of gave you this instant. He's like, look, I'm not here to mess around. Just give me your best and final. If it works, it works. If it doesn't, it doesn't. So then I gave him the number, and it worked. So that is kind of one of the things that you can do with property investing as well, is ask that question. It pre-frames it and sets it like, I'm not going to beat you down. I'm not going to beat your vendor down. But in property context, you say, do you want me to go in low for the vendor? What's better for them? Because sometimes the answer is actually, no, these guys want to fight, and please come down a little bit lower, and then we'll go back and forth, and then we'll end at your number. So no, I'm very excited to take sweet delivery of that thing, and then we can go about it. But I'm pumped for this session. The reason I'm here is because I want to chat to Robbie. He's a certified accountant, and this whole session's about
a chartered accountant, Joe.
What did I say?
It's certified accountant. Well, I mean, I don't know. I'm a sort of
close.
Very offensive.
Yeah. Yeah. So we're going to talk about before you buy a property. What are all the things that you need to think about before you buy the property, and where do people get messed up? And like, you're saving for a deposit. It's going to be 80, 90, 100 and odd $1,000. What are you doing with that money in the meantime to help multiply it? Then we've got after you buy the property, what are some of the things and trip ups that people get stuck with? But where I'm interested in is, as life evolves, as the portfolio evolves, how do we need to think about structuring and setting up the right things in place so that we can actually go about and get this done? So that's what I'm pumped about getting rolling. How are you, Jeff? Actually, I didn't even ask.
Good. Yeah, I'm not going to. There's no 3-minute story. I went to the beach day. It was good fun, and yeah, we had some bike riding, so it was lots of fun. No, I'm pumped about this session. So before we go any further, this information is general nature, not taking into account your personal needs, objectives. Go and seek professional financial advice, legal, tax, and unique to your circumstances. We're not liable for this. And although Robbie is a chartered accountant, not certified, no, he's certified probably as well. But no, so it's a big session. And Robbie, I'm excited to know that you were from down my, you went to uni at UOW, University of Wollongong.
Yes,
You're a Bachelor of Commerce, major in accounting, finance. You've got 15 plus years of chartered accountant, passionate about helping people to kick their financial goals. And recently you've started Save Our Budget, helping people to budget, investment journeys, and the financial well-being, because to me, that's what it's all about. So the first thing I want to, and it's a little bit spicy, and then we'll get into starting the portfolio as well. I want to know, what are you guys, and maybe this is a bit off the cuff, so sorry, Robbie, for not prompting you, scripting you, but the interest rates, are we a little bit concerned about those? Because I think next Tuesday there could be a little bit of a sneaky increase. So inflation's high, unemployment's low. What are you seeing there in the tea leaves, Robbie?
Yeah, so I've been waiting for the announcement on the December's inflation stats, and it's going up. So
yeah, personally,
I think if it's not next week, it's next meeting in March, that I think there's going to be a cash rate increase.
Yep.
It's not good timing for me. I've got my 5-year fixed mortgage coming off in July, so I'm kind of tossing up between doing the math of maybe breaking early because there will break costs. Yep. And then maybe looking at doing a split and fixing some of it.
Yep.
So I did the math, and over 5 years, it's hard to know if the rates are going to go up or down, but could be a potential saving. At this point, not really sure. I'm probably about 80% sure that there will be an increase in February, March, but I'm not ready to pull the pin on breaking my fixed mortgage and refinancing just yet.
Yeah, I must say, it's one of those double-edged swords, because the horse is somewhat bolted, because you've literally seen like 2 to 3 fixed rate increases from a lot of the lenders. So you're sort of saying, okay, great, but you're on a really good wicket. So and it's just interesting.
There's still a couple of sub 5% fixed rates floating around for sort of 2 to 3 years.
Yeah,
so you can get like 4.94 and just over 5. So it depends on your situation. Like if you have fully variable now, I'd probably be inclined to fix some of it and try to lock in maybe 2 to 3 years. There's so much uncertainty in the market. You look at all these, Trump posts, and the market tanks, the market bounces back, the gold and silver markets, property, like everything's just, I would just say it's uncertain at the moment. And it's hard to sort of avoid the noise.
Yeah, so much noise out there these days. I don't know if people, it was interesting. I did a post about about a certain day on the 26th of January, and it got a lot of traction, which not for all the reasons I may have wanted, but that's okay. Yeah. So Robbie, first question that I want to get to is, we're starting out the property investing journey, and what are the things we should be considering, like budget, like how do we go about that? And then the double barrel question is, okay, when is the right time to buy that first investment property from your perspective?
Yeah, so I might answer the second part of it first. So thinking about property, it's pretty hard to disagree with the fact that it keeps going up. So like you say, when's the best time to plant a tree? If it was 20 years ago, second best time is now. So you can almost say the same thing about property. It keeps going up. We've got more houses being built, a little bit slower than the demand, but the price keeps going up. It's going to keep going up. I don't see there's going to be a huge correction that's going to wipe out everyone. I think it's going to keep going up. There's still, I live in the Hills district of Northwest Sydney. There's still places being built. There's still people moving in, buying them straight away. There doesn't seem to be a shortage of people buying. It seems to be a shortage of places being built. So that's that part. Going back to the first part. So where do you start? So most people, I think, you need to have a goal in mind as to what you're looking to achieve is the first bit, I think. So there's a whole bunch of strategies. I see at work with clients, there's a whole range of different ways that they generate wealth. It could be successful in business. They could just be really good savers, really good investors, different options of how they make their money. But the first thing I think is having a goal and sort of laying it out, what it looks like, how you're going to achieve it. What's the first step? Usually is to have capital to invest. Yep. Saving might be the first option, depending on what you're looking for. But I think also having trusted advisors, whether it's a mortgage broker that's on top of things with, rates. We had a guy when we bought our current place, so about 4.5 years ago, he was on the phone to us about a week before the fixed rates were going to go up. So we locked in, we paid $700 to fix our rate for 5 years. Well, to have, I think it was 90-day window to fix that percentage. And then we had to settle within that time frame. So, $700 seemed like a fair chunk of change, but it saved us thousands of dollars over the 5 years. So
over 5 years,
having something like that in your corner,
thousands of dollars.
Yeah, that's right. So I'm too scared to do the numbers. Like it's crazy, particularly because my mortgage is about to go to the rate that it's going to change significant.
It's probably going to fall 5x, right? Like,
yeah, so it's going from 2.19 to 5 something. So yeah,
that's only the interest component though. So it doesn't. The repayments will go up quite a lot. Yes.
Yes.
But yeah, it's not like if you had a $5,000 mortgage, that's not magically. It's not going to jump to like 10, 15 grand or whatever it is.
You see a lot of clients, like you see a lot of successful clients. You see everyone's finances every day. Do you see people like different types of people that you can kind of chunk into? Because for me, we need to set a goal, right? And then we need to reverse engineer, and we need to strategically think about every single step that we're going to make for the next 30 years. I love strategy. And what I found is that there's people that really love that. They love the data. They love the detail. And then there's other people like me as well I just want to know that I can get to my end goal, and then I'm going to optimize everything along the way, because I don't know what's going to happen in 2 years and 3 years and 5 years. Like, do you have any, I guess, like avatars of people that you see when it comes to strategy and little tips and tricks of how they succeeded? It's a bit of a hard question, but it's one I'm interested in.
Yeah, so I guess you could kind of group people into those that just do. So they have an idea, they just jump in. It's usually the people that do have the capital behind them. They've got, they might have investments or something on the side as well, or they've just got a high income and they can take a bit of risk. So if they do just buy a property, for example, and they haven't researched the area, whether it's growing, whether what the ratio is like for the suburb, and they can just jump in and buy something. So there's people that they just do things. There's people that really suffer from analysis paralysis. They have ideas, they start researching it. They're like, is this the right thing to do? They go to a barbecue and their friends talking about something else, and then they get a bit unsure as to what to do, and then they just do nothing. And then I think there's people in between where they're a bit more rational with their approach. They speak with their advisors, whether it's buyers agents, mortgage brokers, accountants, lawyers, and they speak with the professionals, and they kind of put their heads together, formulate a plan, and then they start working out the best avenue from there. So I guess that sort of answers the question.
Yeah. It's interesting. Like, because you're spot on with like people that take action really fast but don't actually think about it. And then on the other scale, you've got your analysis paralysis, where people don't take the action whatsoever. And I guess you kind of see what path they go down and where they need the help. So if you are an action taker, do take action. You've got, actually, it's probably, if you are an action taker, you're someone that's kind of got it. Like, you've got the easier path if you're an action taker, because people that are analysis paralysis, that's the hardest thing to overcome, because you're not an action taker. You're not someone that pulls the trigger. So you've got to kind of go out of your comfort zone to do that. So I guess that's kind of one thing for an action taker. Take a step back, collect your team, and bounce ideas off of them. Take action by speaking with the broker. Take action by chatting with the accountant. Take action by chatting with the buyer's agent, and not just letting everyone go away. But also for the guy that's analysis paralysis or girl, spend the time doing it. But when you've got it, you're never going to be 100% bang on with everything. No house is perfect. No suburb is the absolute perfect thing that's going to tick all the boxes. There might be, it has to be a 4-bed 2-bath or a 3-bed 2-bath. Well, to be honest, this suburb has 3-bed 1-baths or 4-bed 2-baths. So, like, you want a 3-bed 2-bath, doesn't exist. It has to be on 800 square meters. This suburb doesn't have any 800 squares because it's kind of filled in. What are some of the mistakes? So you see everyone's finances. You see the guys just starting out. You see the guys right at the top 1%. Like, where's the middle making mistakes? What are some of the things that someone might be let's start at the beginning. What are the beginners' kind of mistakes are, and then the middle, and then maybe some of the 1%ers?
Yeah. I think it's probably the same sort of thing across the three, to be honest. So the main thing I would say is the ownership. A lot of the time,
as in taking ownership, or the structure.
No, so the structure. Yeah. So who's going to own the property? So a lot of the time, clients have the idea, they want to build wealth, they know property is a good avenue, you can tap into leverage, etc. And there's people that will help you find a property. But if they're putting it in the wrong name from the start, or they're not considering the short-term and then the long-term tax implications, it can cost them lots of money along the way and also down the track when they sell. So that's probably one of the common things that we try to train our clients not to do. But there's some that, for whatever reason, don't pick up the phone and just ask a simple question. So I think that happens across the board, where they might have some money sitting around, they want to deploy it in the property market, and they just make a decision, but they don't think, maybe I should have put it in the spouse's name or joint names, or possibly we've maxed out the land tax thresholds in our name, so maybe we'll set up a trust, or potentially look at a commercial property in the super fund for the business that they run, for example. So, I'd say that's probably the main thing we see.
What I wanted to say on that, because it's interesting, because is there a way of future-proofing? Because the challenge I face with where there's particularly, it's hard to get the best of both worlds, because you've got, let's just say one party of the couple is earning 300,000 and another part of the couple is earning 100,000. There's even, let's just say 70, 80. There's likely benefits having it in the higher income earning spouse at the moment. But then down the track 10, 15 years, and assuming things don't change, then there's going to be a higher tax liability for the capital gains tax if you do a bigger split to the higher earning spouse. How do you kind of weigh that up when you're thinking about this in conversations?
Yeah, it's a good question. So I think the structure is important, but also the exit strategy. So you need to have a goal in mind as to what the time frame for ownership looks like. So if you're in your 40s or 50s and you're looking to retire soon, say 10, 15 years time, it might make sense to have a property in joint names, for example, because you're both going to take 50% of the capital gain on your returns. You're both going to get the 50% discount, and you're not going to have income if you're retired. So strategies like that, it differs at the sort of life cycle stage that you're at. So if you're in your 20s or 30s and you're starting out, you may not have a partner, you might have just recently got married. The considerations there will be different, but you do need to think longer term down the track what it's going to look like when you sell. If some people say if you've got a property and you can only access 80% of the equity, it might actually make sense from a maths perspective to sell it, access all of the equity, and then put down the deposit on 3 properties, for example. So if that's how aggressive you're going to be now in your, say, 30s, 40s, maybe the structure might differ. So there's lots of different considerations depending on age and your goals. So it's very hard to sort of nail down one specific approach. It really depends on household income, how old your kids are, what your goal is, whether you're looking for passive, if you're looking for growth, and then what does that look like in 10, 20 years time.
And oh, sorry, guys. You go, Joe.
Yeah, I was just going to say, I mean, it does have a big impact on the tax liability for people, and actually, structuring it 90% or 100% to one person sounds maybe great right now, but yeah, when you sell it, you're going to get whacked, and then when it goes to positively geared, then it sucks even more to be in that person's name.
Is there a strategy though? And maybe have you seen people? Because in my mind, I'm thinking, can't we then just, because if we're selling a property and you've made 500, 600, 700,000, whatever it is, you've done really well, amazing, congrats to you. Can you be a little bit sneaky and just say to your employer, hey, look, I mean, I don't know, maybe do you see people doing that where they cut back to 1 or 2 days of work a week, and is that can you do that legally, or is that kind of vague?
Yeah, of course. So I'm in a couple of different communities online, like property investing, fire-based as well. And there are people that when they're in their sort of tail end of their career, they're earning good money, and they sort of start prioritizing being around for kids that might be going through school certificate, high school certificate, that sort of age, when they're sort of in their mid-50s or so. When they do sometimes take a step back. They've set themselves up, they've paid off their house, for example, they've got some investment properties. They don't really need the money, they're quite comfortable. And we do see some people, particularly if it's like the couple both working, one might drop down to 3 days a week. So there are situations where people plan ahead if they're very like interactive with their affairs and they start thinking things through like clearly. People do sometimes drop back their work so that then they can factor in a capital gain on a property or whatever it might be.
Yeah, I realized that we had the soccer theme and you're wearing the Liverpool. That makes sense. I didn't make the connection. Sorry.
Yeah, that's exactly it.
I was like, you didn't tell me. So I was like, but I realize it now. What I want to say on that, because where you've got, is there a way where you can, and this may only be for the self-employed, but is there a way where you can defer or transfer some of that tax to, let's just say you've made $800,000 in a property or sold it, whatever it is, and you're PAYG, or is that just not an avenue and we're going to the advanced stuff. So sorry for those who want the beginner, but is that achievable? Not really. Probably not, is it?
So for the PAYG employee, I haven't seen it happen.
Yeah, I didn't think so.
For those that are self-employed by their own company, depending on the ownership structure doesn't matter. But of course, you can defer salary. It's your choice whether you pay yourself monthly, weekly, or if you miss a quarter. I guess it just comes down to your circumstances and what sort of income and cash flow you need to live, whether that's something that's sustainable. But of course, that's an option.
Yeah, I like that. I like this question, and then we'll go into, like, I'm sure Joe's got about 800. Like, I love how Joe, he just comes up with questions on the spot. Amazing. What would India's asked, because I like this, because we talk about couples, but what are the safest for a single person, multiple properties? I understand it works in a couple, but is there, I suppose, in terms of ownership, like, how does that, is there a way that a single person could still have some benefits?
So up until recently, there was a potential to split trust income between family members. And the ATO has reminded tax practitioners and people that administer trusts that if you're going to be distributing trust income to your children, to other family members, the cash is supposed to flow with the distribution of income. So quite often what used to happen was mum and dad are on, say, 190 to 250,000 income. They distribute it to their kids who maybe they're 18 and they're tax useful. Maybe it's to mum and dad that are retired, and a loan account just sits in the trust. So the ATO has been cracking down on that, particularly the top end of town. So, the 1% groups that have got huge disposable incomes in trusts.
Yeah.
So going back to the question though, for a single person, there isn't that many options to use a trust unless you've got beneficiaries that are useful. And at that point, I would probably say a trust wouldn't be the best structure, because you don't want to be distributing income and having to pay out capital from the trust to that person. So the trust would basically just be distributing to yourself. So whether you own it yourself or in the trust, it doesn't make much difference. You're going to be taxed on that income. So probably not an option. You could look at a super fund or potentially a company, but there's drawbacks and benefits for both of those, I guess.
Yep.
The main one being in a company, every dollar's taxed. There's no tax-free threshold. You don't get a capital gains discount. So the full capital gain is taxed at 30% unless you're carrying on a business. And most of the time, if you're investing in property, you'd have to have quite a few properties to be deemed as carrying on an enterprise. So there's that consideration. The super fund avenue is something a lot of people, it depends what you read and where you look. A lot of people think that all the rules are changing. We're going to have to be 100 before we get access to our super. People just don't believe in the system. But from what we see in, servicing clients and that sort of thing, super funds are a super powerful tool. Yes, there's changes coming, $3 million balance caps and different treatment for people that have, $3 million per member. We see that a lot. But if you're single in your sort of 30s or so, you might face that problem down the track. If they index it, which we're hoping for, it's not going to be $3 million in 10, 30 years' time. It's going to be a lot more. So investing by a super could be a good option, particularly because you only pay 50% tax on the income. Negative gearing wouldn't be as beneficial if you're on a high income personally, but the capital growth, if you are looking to hold long term, and if you're a sole member, or if you have a spouse that's a second member, and you're both in pension phase, so you're retired over, you've reached age 60, you've retired, you've met a condition of release, you can sell a property, and it depends on the taxable and non-taxable benefit makeup of the funds in the super funds, but you can basically sell it tax-free. So that's one of the biggest tax loopholes, I guess, that's legal, is to start building your wealth through super.
Well, yeah, typically we see a lot of people, property investors, typically looking at super after they've kind of tapped out in their personal name, just anecdotally, where they're buying investment properties, they see a market, they see markets that are growing and moving, and then their borrowing capacity hits, and then they've got about $250,000. That seems to be the number that people are moving on. Great, we can get something set up and structured, get a self-managed super fund, and then they're investing in property. And in that meantime, that's taken a year to get that acquisition going. Then their personal portfolio has grown enough in equity and borrowing capacity, because the self-managed super fund borrowing capacity is a complete different entity. It's not really considering you as a person, except for your contributions that you're putting into it. So it is a great way to scratch the itch and continue building a portfolio out. One of the things that we mentioned on one of the pre-calls was like inheritance, or like a windfall, and that's something we haven't really spoken about on the podcast. Is someone just inherits $1 million, $2 million? What has worked and what hasn't worked? Because I imagine some people that aren't financially literate, they don't really know anything. They go out and buy crazy stuff. They go buy a boat, and what are some of the mistakes that you've seen? And then what are some of the more successful things that we should be thinking about before we spend it all?
Okay, I'll just quickly go back to the super fund thing.
Oh yeah.
One of the quick ways to build the funds in the fund as well is to have your employer contribution going in, 12% now. You can also make a personal deductible contribution, build up the funds, and like you mentioned, it ranges from $250 to $400 depending on where you're getting your advice from, how much it costs for a statement of affairs, the ongoing accounting and tax services as well, as to when it makes sense to switch to a self-managed super fund. But if you're putting in up to 30,000, part of it being tax deductible, potentially putting in non-concessional contributions as well, you can quite easily build $500,000 over sort of, a 5 to 10 year period. And there's, 5 deposits on 5 properties. So that can really, like, I guess, make it a fast track approach. Yeah, accelerate the path. Yep.
Yeah.
So windfalls. So the most common thing we see is, I think you sort of touched on, is people just buying dumb shit. So
not a Lotus 7 though. That's a great acquisition. I support that.
I'm going to have to Google it later, and then I'll pass my judgment once I look at it. But
it's worth a Google.
It makes Joe happy. That's all that matters.
That's it. Yeah, they say money can't buy happiness until you buy a Lotus 7.
Clip that one.
Yeah. Oh, actually, on the tax on the, I can't put this, through my company, can I? I can't just buy fun toys and put them through companies.
I mean, depends on. Do you want to slap a company logo on it? Is it a company card?
Well, yeah. It will be. I'm gonna have a company logo on it, but I'm fairly sure it's just gonna, like, the company would just pay for the logo. They're not going to pay for the car.
It depends on the business use. So if you're out driving around meeting clients all the time, then it depends on the cost of it. There's GST limits, depreciation limits to factor in. But yeah, if there's business usage, then it is something you could look at. The private use is usually the deterrent though, because there's fringe benefits tax on private use. So it depends on the usage. So like a lot of things in tax, it depends.
Yeah, I know. It's having somebody who worked at the tax office, even in a non-tax technical position, that literally a word or two in the interpretation completely changes the way that something gets applied. So yeah, what I was getting back to, like, I looked at the slides. If you bring up these slides, because it looks like you put a bit of effort. I'm just looking at them now.
Which one? What number?
Let's look at the foundation. So slide 5 of 14. Because there's a lot of I suppose interesting concepts on this. So retirement, investing, books, identifying financial goals, needs versus wants, non-negotiable. So these are all the things, I think, going back to the beginning, like, if you can get clear on these things. But I'd love to, the thing that really piqued my interest is some of those book recommendations and how they tie into all of this. Robbie, how do they help people discover those all the things you talk about here?
Yeah, so I think you need to have strong foundations, and I was lucky enough that my mum and dad taught me from as far as back as I can remember. I used to see what they did, what they spoke about, how hard they worked to raise a family, to put a roof over our heads, and that's sort of been passed on to me, and then I'm trying to pass it on to other people as well as my kids. But having those foundations nailed down, I think, changes the path that you go on in life. So, it's quite easy just to go and blow money and try to buy happiness and buy tools and toys and things. And that's all well and good if you can support that sort of lifestyle. But if you really want to focus on investing and building wealth for yourself, so you can retire early, so you can retire and live, off $100,000, $200,000 a year, then there's things that you need to have in place that will help you get there. And you need to kind of stay on track, stay disciplined. So I guess one of the things we see a lot on is like needs versus wants. So keeping up with the Joneses is a classic example. I live in an area where I'm pretty sure the Hills District, if not in Sydney, and maybe even the state or the country, has a really high adoption of electric vehicles, particularly Teslas. I think they're the highest owners of Teslas in Sydney, for example. So it's very hard to see Teslas driving around on the street all the time and not want one.
Yeah.
Whether you need one is the question that you need to think about. So, like, what's it going to do for you? Is it just going to be a trophy where you can show it off, or is it, is it going to save you money down the track? Can you claim it for, your job or on the business? I guess just nailing down what you actually need in life, what your income can support, and what you're going to do with the rest. So I guess it goes back to then setting goals. One of the main things that I think is also really important is if you've got a partner, is to speak with them and sort of line out what you think your sort of future looks like from a financial point of view, what your goals are. As an example, I was going back, I think it was 2013, I think. I met my wife. We're both at the stage where we weren't really keen on dating. Tinder just came out. We're kind of ready.
I mean, I thought Tinder was around. Sorry, go on.
Yeah,
I digress.
It wasn't around for that long before I met my now wife, but I basically I messaged her and I said, let's go for a drive. He went to North Head, like Manly, the northern tip of the harbour, and she thought I was going to break up with her because there must have been a pretty serious tone in the message. But I wanted to meet and have a chat and say, I think what we've got is something special. I can see a future between the two of us. I can't live at home forever. We're mid-20s. At this point, I'm not interested in renting. I want to buy a place. So if you're on board, let's give this a real red hot crack. Let's start saving. And I can't recall how long it took us, but it was actually not that long. Like, we had a common goal. We're both working toward it. We were still going on dates, getting to know each other, but on the sideline, we were saving money. So having that common goal really pushed us to save, and that's how we got our foot in the door originally. So
that's actually commitment. That's courageous to do that, because I mean, I suppose back when I remember when the relationship was formed with me, I was like, how do we avoid buying the owner occupier? Because I want to keep investing. But so so that's interesting, because you were. And I think that's important. And I think that there's a lot of people that you need to have those conversations with who that's important in your life, because it can make or break this financial freedom, the financial independence, retire early. So good on you for sharing that. And I think that it's an underappreciated aspect, because if your partner's supportive of whether your goals is to build a 10 to 15 to 20 property portfolio, or whether it's to buy that home in the hills or that home in Byron Bay, I think it's important you're aligned. Otherwise, it can create division, probably, I feel.
Yeah, I think so. Going to the opposite side of the spectrum, I guess, one of the main reasons that couples end up splitting up and getting divorced, it often comes down to money and finances. They don't, most common, it's a stay-at-home mum. My family upbringing was a bit different. I had a stay-at-home dad. My mum was a breadwinner. They made that choice that for our family, that was going to be more prosperous for them. So not saying that stay-at-home mums is the reason, but a lot of the time, one of the spouses is at home, and it's quite easy for some people to fall into the trap that I'm the one earning the money. I get to choose what to do with it. But it's really a team effort. So that seems to cause friction if you're keeping the money to yourself, making the decisions, and the parent is at home, got the burden of raising kids by themselves, which is a huge job, and they're not getting paid for it. They're not getting the appreciation they deserve from the other spouse. So that, I think, it's a huge thing you see. And these days, it's like, 1 in 5 people you talk to seem to be having issues. So I think that is a really big thing that needs to be sort of discussed early on, is kids, but finances, how you're going to deal with it, how you're going to work together.
Yeah, I like it. So we've got the how to lay the first brick. So we talked about saving for deposit, checking borrowing capacity, so on, slide 7. And people are asking about specific locations, and I'll indulge some of those questions. I'm not expecting Robbie to answer them, but I mean, you can if you want to. But the first brick. Or do you want to talk about that one? Where do you want to go, mate?
Yeah, so first brick, I think, is I think even before that is just having a plan, having a chat, having the professionals in your corner working for you, ready for when you pull the trigger. And then you just got to work out how to save your deposit. So depending on which avenue you're going to take, could be through super, could be in your joint names, could be a single name. So having that sort of idea and concept and running it by someone. So speaking to your tax agent, speaking to people that have already accumulated properties in their portfolio, asking what works best for them, and then just taking the leap. So making sure that you've got the capital behind you, you've run your numbers, you worked out what your borrowing capacity is, you've spoken to your broker, you've got an idea of the council rates and all the ongoings, the maintenance, depending on the age of the property, sort of factoring all that stuff in, and just jumping all in when you're ready.
Yeah, there we go.
Yeah, I'll bring it up on. I'll bring up the page here.
Yeah. Perfect. Yeah.
Bit of a visual representation. Save for the deposit. Check your borrowing capacity. Do the sums. Locate and acquire. It's that easy. Yeah. It's that easy.
The thing I would say about this, Robbie, and just to add to it, and Joe, I think you'd probably very much be on the same page, is you really, if your goal is to build a 5 or 10 property portfolio, probably maybe go beyond the average, not the average, that's a wrong way of putting it, but the person who's simply thinking about that loan at the CVA or the local broker down the road, or because we've all been to that person, and it just, you kind of, you don't know what you don't know, and you just take their advice at face value. And then you realize, actually 3 to 5 years down the track, crap, I didn't need to sell that property to get into the next one. I should have been leveraging the equity, and there are many other lenders out there I could have considered. So that's probably laying the first brick, but laying the next brick as well. Maybe I'm a little bit ahead of where I want to be, but how do you think about that, Joe?
Yeah.
How do I think about it? Yeah, I think you've got to get the right people around you, but you've got to future think about what the next property needs to be. I've chatted to people before, and they're like, yeah, I was chatting with my broker, and they told me to like cross collateralize this loan, and I'm like, okay, well, what's the kind of the goal here? Why are we doing this now? I can see the value eventually in cross collateralize, see like more strategic, 5, 6, 7 properties in when someone's doing that. You don't necessarily need to do it now. Why'd the broker recommend that? And the answer was, well, she just had another option. She said the other option was just get the normal loan and process it through withdraw equity out and do. I'm like, so she didn't tell you which was best? She's like, yeah, they're both, the same. But I'm like, they're absolutely not the same. She's like, I did some Googling and they're definitely not the same. I'm like, okay, great. You might need to speak to someone that's going to think about your next.
It's a great example, Joe. It's even like kind of, I don't know, about the property selection as well. Like you're kind of thinking about, like different parts of the same suburb. Like it's not the same sort of, you probably get a very vastly different result potentially.
Yeah. And the other thing is all of this stuff is really annoying. Saving for a deposit, really annoying. Checking eligibility concessions for rebates and LMI, snooze fest. Like checking your borrowing capacity. So one of the things you kind of mentioned is like, the average is this, the average is that. Just don't be average. The average person is 30 kilos, 20 kilos overweight, smokes 6 cigarettes a day, and on average is knocking back beers left, right, and center. You're not average, so don't do what the average people do. You've got to kind of take a step above and take the action that you need to do, and that's where that kind of Eat That Frog book that I literally just I haven't read the book, I haven't know anything about it, but
Brian Tracy,
I just bought it on Amazon just now because I'm like, that's good. I'm going to learn something. And how can you take advantage of just taking? I imagine it's eat the biggest thing first that you need to do so that you can get to the next one, and then eat that thing that sucks, because all of these things suck. But if you can do it, you're going to be able to buy an investment property, and if you can deal with the negative cash flow of the portfolio, you can, because you've done the numbers, you've crunched the deals, you know that you can afford that negative cash flow. The banks are lending you the money, and they have shaved your income 20%. So it's now based on 80%. So the banks are willing to give you this money. You've run your budget. You know you're willing to go, that you're going to be able to afford it. If you go buy a $40,000 boat, you're not going to be able to afford it. So you're going to have to take some sacrifices. But if you keep going and making it happen, you're going to be able to do it. I guess
I think the earlier, sorry to interrupt. The earlier you think about making sacrifices and putting the extra money aside to build a deposit and to build your portfolio, down the track, you can then make decisions that might be more for personal pleasure rather than being so stringent and saving every cent. So the earlier you start, the better, definitely.
I listened to a great pod. Oh, sorry, go. I was just going to say, on your point, Toddy Sloan, like we're mentioning a competitor, not a competitor. He's a comrade. That's a funny way of putting it in these times. But he had a person on there the other day, 25-year-old, and as a couple, a $9 million portfolio. I was like, that's like good on. And I was just like, what's going on here? Like I had to listen to it. I was curious, but good on that sort of, I suppose, couple. They just sacrificed. They moved interstate, but rented out the property as an Airbnb whilst they were having that experience. And I was just like, wow, like this is just the kind of content that we hopefully want to see. But to your point about eat the frog, like, do you want a hard life now and an easier life later, or an easier life now and a hard life later? Both options are viable. They can both work for you, but which one do you want? Just on that, before we, speaking of a hard life, let's talk about a property, because sorry, I'm taking this off track here, because I think you'll have some wisdom and some nuggets to drop here, Robbie, as an accountant, but also as an investor. So is it worth holding Melbourne Epping property 2-3 years more? It is recently under planned activity centre zone. So maybe there's something happening there, which means they can build 4 to 12-story building, and my land size is X amount. You don't have to talk about
what's X amount and what's their land size? Just one property?
550 square meters. So nothing special. Right. It's not like a 6,000 square meter. So how do you think about that, Robbie? How would you unpack that question?
So I've got a client that is in this, I guess it's a similar situation. I don't know Melbourne property market. I don't know property markets like you guys do, like lots of people that probably tuned in tonight do. That's not my specialty, but if there is a rezoning in play and you're in the pocket where they're going to slowly acquire lots of lots and turn it into multi-story residential apartments or commercial or whatever it is, there could be a reason to hold on to a property. If they're not going to do that, would you still hold it? Most of the time, people are not going to just buy a property and sell it tomorrow. They're looking to hold on to it for either yield or for growth. So when you're talking 2 or 3 years, it's a pretty short time frame to be thinking about flipping a property. So I would probably be inclined to hold on to it. But I've got another client at work. They're negotiating. It's in North Sydney somewhere. There's a whole bunch of owners. There's a back alley. There's a street, and they're looking to sell. I think there's about 12 together, but only half of them want to currently sell. So they're trying to work out whether they can develop a smaller multi-story building or if they can do one bigger dwelling that's, I think 8 stories is a limit or so. So it really depends. Like it's a hard question to answer. You'd have to check all your zoning with the council, try to speak to some property developers or those in the know and work out what's happening, what's planned, and then decide from there.
Yeah, I thought you might have gone in this path, but the way I think about it is, how does holding or selling help you get towards your goal? Is it moving you closer or is it moving you further away? If it's moving you closer, if that potential develop, and if Epping, I know there's a lot of interest in Melbourne right now. So yes, they may see some capital growth, but if it's moving you closer and it's not stopping you, then you don't need to overcomplicate it. Just go and potentially extract the equity, go and buy another one. Like, why do we need to even consider selling now, unless there's a reason to? How would you answer that, Joe? Sorry, is he frozen or have I frozen?
No, I froze.
Yeah,
I froze.
Yeah, he's frozen.
So I missed all of that. Just carry on.
Okay, yeah. All right, cool. Well, you're about to say something profound, but no. How would you attack? Well, so basically, I said, hey, look, is it holding you back in your property investing? If it isn't, then I don't necessarily see. Look, you're in Melbourne's getting a lot of interest right now, particularly those sort of areas. So whether you can develop it or not, I mean, does it stack up as a property now? And if it's not holding, how do you think about that, Joe? Is that kind of your? Well,
yeah, I guess the question is, like, do you even need to sell it? Why are you selling it? Oh, I need to sell it so that I can get into another deal. Or can you just get into another deal and let that thing do its thing? Like, the reason why you consider selling a property is because you believe that it's not going to perform and that you can get a better outcome even after selling costs and paying the tax, a better outcome on that next purchase, including the buy-in of the stamp duty. And a lot of the time, selling costs, stamp duty, buying in again doesn't make sense. That gap between trying to get in. The only time it does make sense is when you're like, well, I have no choice. It's either this rubbish asset that's stuck here doing nothing, or I'm going to have to just bite the bullet, lose, 50K, and then restart again and get a better asset because I'm more educated, because I bought a property 6 years ago and I was an idiot and I took action too quick and did that. So for me, it's like, do you need to sell it? No, great. Don't bother. Like, it's going to grow, maybe. I don't know. But the beautiful thing is, like, I have a friend who is just an absolute savage, and what he does is he just goes through. He does this kind of developer process of just reaching out to all of the neighbors and chatting to them. Hey, you guys considering selling? Bundles them all together. I saw one in the Northern Beaches, 28 units, 28 houses put together to create this thing. But it's a lot of work to be able to get all of these neighbors. So if you had a larger block, like 1,000 squares, you've got a little bit more leverage. But you really, actually, what was the question? Like, 4 stories, you don't need that much land to do it. So you might only need 2, 3, 4 neighbors, and you could create something pretty cool. But you've got to do it. No one's gonna knock on your door. I mean, maybe, but no one's going to knock on your door and say, "Hey, let's knock this sucker down and create the development." You need to.
I like that Gaurav said he chimed in with the contrarian view, and Gaurav, Robbie. So he said, "What if this was to pay off? What if this was to pay off non-deductible debt and recycle?" Well, I mean, I don't know that that Capital's actually thought that deep, Gaurav. So I don't. Maybe I'm making assumptions here, but I just so maybe, but maybe it could be his own as well.
It's a good consideration. So a lot of people, particularly wealthy people, have properties that in the multi-million dollars. They have huge loans, and the interest is not deductible. So sometimes, if you run the numbers, it can make sense to sell a property, pay off your principal place or main residence loan, and then debt recycle and invest again, because then you can claim all your interest on your main residence because it's now used for an income producing purpose. So there are situations where people do that. There is risk. I don't think it's a huge risk because you still have the same loan whether you've got your property or you've got two. The property market is generally going to keep going up. So I think the benefit outweighs the risk of debt recycling. But it's definitely, you'd have to crunch the numbers to work out what it looks like after tax. And you also need to consider, just back end of last year, the ATO has come out with some examples and some, I guess, interpretations about debt recycling particularly. So if you've got 2 people on the loan, so mum and dad, for example, and the mum goes and buys a investment property, income producing asset, the interest is generally deductible. The ATO is now saying if you've got 2 people on the loan and 1 person owns the property, so this is debt recycling, so your principal place or your main residence, you're using that to then buy. If 2 people are on the loan and 1 owns the asset, if you don't have an agreement in place to say that that person is purely responsible for the maintenance of that property, the ATO is denying deductions for half of the interest.
Wow.
So
Jesus.
It makes sense from a logic.
Can you retroactively creating an agreement?
You have to have it in place before or at the time of the loan. So it's something that a lot of people debt recycle. It's not a common thing. It's not an uncommon thing, but it seems to be kind of catching traction on the social platforms the last sort of couple of years or so. But
the
ATO is knocking back deductions now, and they're looking into this now. So they've been threatening for multiple years that they're looking at property owners and rental properties and deductions and so forth. I haven't seen it yet. Haven't had any audits, but it sounds like it's starting to creep up. They're using AI, and my view is that the governments are controlling unemployment. They start hiring people to fill places, like when they build major highways. And
raise interest. I don't know though, because do we want it? We don't want unemployment to be potentially lower though, because
that's right.
Because then
it's just dropped
inflation
as well.
and interest rates go up, and the debt that the government needs to reduce
I had
lower
this,
there.
Talking about like debt recycling, I had the question posed to me today, and the question was, I've got a PPOR and I've got an investment property. That investment property has grown $200,000. I want to take the equity out and then place that into my PPOR. Am I allowed to do that because I want to offset the PPOR debt?
Yeah. So it's a common thing that people think is
just exciting.
It sounds like a great idea, right? You're paying down some of your loan that's not deductible, but the interest on that portion is not deductible now. So the only way the interest is deductible is if it's used for an income producing purpose. So it's deriving rental income, it's in the stock market earning dividends. There's got to be a return that you receive that's taxable for it to be deduction.
Yeah. Before we go to our first break, I just wanted, this is maybe a spicy one. So build cash deposit rather than equity with first by paying off extra offset accounts, etc. What are we? I mean, I've got some views on that, but what do you think about this, Robbie? What do you think?
Yeah. So there's a few people out there that. So there's one particular guy who's a tax lawyer. He's an expert in tax law. He's also interested in different avenues of investing. And I see quite a common response to things online and in the property chat forums and stuff is, why pay off deductible debt?
Yeah,
like it's tax deductible. You're not really advancing your situation, paying off debt that you can claim as deduction, pay off your non-deductible debt, and then look at growing your portfolio. So property is generally going to naturally provide equity by growing. So it's sort of a set and forget approach, I guess. I wouldn't be paying off extra of the investment. I would be putting it in an offset to then build up another deposit to then go and buy another property. You can then, the tax benefit of the offset versus redraw is a consideration. So you're better off having all your funds in an offset because it's not linked to your redraw and your mortgage on your main residence. So you can use those funds and it doesn't impact the tax deduction or anything like that. I would let the property do its job and save money in your offset.
Yeah, there we go.
Love it. Okay, well, let's dive. We'll jump into our first sponsored ad, and then I want to dive into some of the more like strategic approaches for someone that already has a portfolio that's already starting to think long term. Let's rock and roll.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
We are back.
Excellent.
Yeah, it's crazy that we 75,000. I think we need to get that updated.
Yeah,
that's crazy, isn't it?
You've got another 10%.
Yeah, I know. Jeez. Yeah. What I want to say, we will, because I see you put a slide on the commodities boom. So it's an interesting topic. I kind of want to hear a take and maybe non-property assets, your view as to where they sit in the portfolio. But Joe wanted to hear the more strategic stuff that people are doing. So
one of the questions I had is like, what are the kind of key conversations? They've purchased the property. What should we be having a chat with our accountant about after we've already purchased the property? Obviously, we kind of chatted about some of the pre-chats. What are some of the things we should be bringing up? Cool, where we're kind of thinking about the next thing. What should we be thinking about and asking?
Yeah. So it comes down to the structure again, I guess. So I think it's important to revisit that sort of each progression in your journey. You might, each state's different. So you've got land tax to consider. So you might have absorbed the land tax in your personal name with one property, or it could be a handful, depending on the value and what the land tax threshold is. So then it's like, all right, well, I've maxed out my land tax threshold in New South Wales. I've still got capacity in my personal name. Maybe I look at Melbourne, maybe I look at Perth, Queensland, and to look at just diversifying by location is a good one. So that can save quite a bit of money on land tax that way. And then if your borrowing capacity is starting to sort of get stretched, is looking at the vehicles that you can use. So there's been a lot of talk lately about unlimited borrowing power and trusts. And I think the back end of last year, banks have started sort of tightening up their policies. So it used to be if the trust was self-sufficient, you could lean on your accountant and get them to draft a letter saying that the trust can meet its debts, and they basically disregard the debt that the trust has. So it was probably, I'm going to say it was probably 2 years ago, the Chartered Accountants Institute and the other professional bodies came out and they gave us very strict guidance that said accountants are not to be writing letters on behalf of their clients stating that they can service a certain debt. That's the mortgage brokers, the bank's job to test their serviceability. What we can do is state facts. So we can say for the FY25 financial year, our client's income was X, they have a trust, it had taxable income of X. We can't be saying this client has 250K income, the trust has got 3 properties, and we think they can go and buy another 5 properties if they set up another trust. We can't be doing anything like that. So we can state facts.
Were there accountants actually? I mean, because my sort of inside, not inside, but I suppose what was is all the accountants letter is sort of should be clarifying is that is that entity meeting its commitments, and is it trading or non-trading? Beyond that, I don't think there should be anything further than that.
That's right. And
at the time of thing, because no future prediction should be made as to whether it will continue to do so or not. Because
exactly right. So that's the key point is like we can talk about historically what's happened, but we can't. No one can guarantee what's going to happen down the line. So there's been situations where accountants have been doing and sometimes it's being pushed by the brokers as well, saying go and get an accountant's letter. I need this accountant's letter so that I can approve the loan. It's like, well, hang on a sec. I don't know if they're going to be employed in 2 weeks, 2 years time. I can't prove any of that. So there's a fine line between what people want and what we can actually do. And it's something that's sort of been cropping up in the last couple of years as to like we've had emails at work circulating. Just a reminder, we can't be providing accountant letters to prove that our client can meet the repayments on a loan. Like it's not something that
it's wild that people. I mean,
So one of the questions I have is this whole trust thing, right? I feel like it blew up in the media 2 years, and then I think the banks have to be like, well, look, we're not that bad. But I mean, this is one of the ways that the wealthy keep getting wealthy, right? They come up with these different structures. I just feel like this trust thing has become a little bit more out there, a little bit more obvious. So okay, so let's say they take this away. Then I don't think they're taking it away, but let's say that they do. Is there another gate that opens for the wealthy to be able to sort out their money?
Yeah, so from a capital gains point of view, not really, but from an income point of view, what's common in the top end of town is to have a bucket company. So you've got a trust that owns properties, you've got your borrowing capacity, you've got your property portfolio humming along, and you've got a company as a beneficiary, and they park the profits in the company, and the company pays 30% tax because mum and dad might be already on 250, say, even 190. So you're paying 47% tax in your personal name. So quite often it's a strategy we see where you've got a standard family trust or discretionary trust, and you've got a bucket company as a potential beneficiary, and you're distributing money to the company from the trust. And then it's accumulating. You're paying 30% tax instead of 47. So out of every $10, you can then invest $7 instead of $5.30. Or
is there a bit of a risk, in my understanding, that the top up tax where it can, like, because eventually it has to the profits will have to go.
It works really well for those that don't need the money. So if you're building wealth and you've got a high income, or whether it's passive or from employment, and you don't need the money now, and it's just purely a wealth generation approach, then having a bucket company can work. But if you have, like, the average mortgage, I think, is around the 650 mark or so. Yeah, if you've got a mortgage like that, and even higher, and you're trying to supplement your income, then that's not going to be a good approach, really, because it's just a timing difference, right? So the company pays tax at 30%. You then pay a franked dividend to get money out of the trust in the company structure. You're paying top-up tax on that dividend. So the franking credit flows through the company to the whoever the shareholders are of the company, and you get the benefit of the 30% tax rate. But if you're on whatever income, if you're above 32, 34, 47%, you've got to pay the difference. So if you need the money, that sort of bucket company strategy is not going to work in the short term. If you're trying to pay off your home, for example, you've got a $600,000 loan, you want to start repaying it, you might be thinking about debt recycling, that sort of thing. There's going to be this top-up tax situation. So you need to think, like, overall, is there a spouse that's on a lower income? Well, then maybe it does make sense to flush out dividends and profit that way, top up their income, and then the other person might have a high salary. So it's always so every year we're reaching out to clients and we're saying, it's time for some tax planning. We need to look at your structure, your trust, bucket company, franking credits. What are we going to do? Propose resolutions and get them to make the decision as to what it looks like for tax time. And then we process down the track. So,
yeah, interesting. Okay, so there's still ways, but I guess when you are super duper wealthy, the borrowing capacity isn't such a constraint and isn't such a concern because you're able to just borrow. So, interesting. Are there any other kind of interesting things that you're seeing from a structure perspective where people are, get optimizing it and taking, getting a good whack? Maybe not the super duper wealthy, but like some of the more switched on investors that might have 4, 5, 6 properties, but they're things that, like, you got to kind of reach this level and then you're like, this is really cool.
Yeah, so something is a bit out of the box. There's a lot of people that are talking about, like, Geo-Arbitrage and even moving to a country with lower tax rates.
What's the favorite country if you can share?
Southeast Asia is pretty popular. So
Thailand,
Thailand, Bali,
Philippines,
all those sorts of regions. Vietnam. The cost of living is far less than what it is in Sydney, for example. Most places in Australia as well. And if you're not tied to living in Australia, some people are just taking their money offshore. They're cutting ties with Australia, moving overseas, living like kings and queens, and doing whatever they want. So I guess it comes down to your family, I guess. Like, I didn't want to move out of Sydney personally because my family and my friends are in Sydney. So it was a hard decision for me to move too far away. But if you're, flying like the old double income, no kids, and you don't have any school commitments or anything like that, then people are starting to consider moving abroad.
Yeah, in my business, we've got a guy that lives in Bali, Aussie guy, built a massive portfolio, sold it all down, and now just lives like a king in Bali, and then does a couple of client calls for us. And similar time zone, and I think it's the same time zone as WA, and you can just absolutely crush it. It's like $4 for an amazing lunch that you would pay $45 for here. Rent, I think, was like $2,000 a month for a nice, like a really, really nice place. And interesting. Okay.
A lot of people in the FIFO space do that as well. Like they just live in Bali and they fly back for the money, and they do week on, week off.
Wow.
It's just, I suppose, how flexible your circumstances can be. Yeah, I suppose at some stage I'd want, but just I don't know. It's just a mindset shift, I imagine, like a complete mindset shift. One of the things, so I think we've got a couple. We've got to throw to our second sponsor, and then I want to unpack the alternative assets and where they sort of sit in the journey, because I don't think we talk about enough. I think you've got a little bit of a passion, so you've got a bit of a slide on commodities and all that, and be interested to hear your thoughts, but also just on the plain vanilla ETF stuff as well. What are your thoughts on that?
Yeah, sure, sounds good.
We're back.
Everywhere you look, someone else is making money in property except for you. Your mate, he just bought a house. It's already gone up $100,000. There's some bloke on Facebook, he's bragging about pulling in a 7% rental yield. Meanwhile, you're stuck scrolling real estate and domain, confused as hell, and having no idea about where to start. Or maybe you're that mate that's got $100,000 in equity. You have a few properties under your belt, but you feel stuck. You're unsure about how to scale without over-leveraging and not knowing what the next right move is. So why does it feel like everyone else has some kind of secret that you're missing out on? It's because they do. There's a reason some people keep stacking properties while others sit on the sidelines stacking excuses. There's a reason why some investors buy under market value while others pay too much. There's a reason why investors know the hot spots before there's any heat. And there's a reason that some people build $150,000 in passive income while others just spend years thinking about it. And it comes down to knowledge. And that's exactly why Jeff Miles and I, Joe Tucker, created the Level Up Property course to hand you the exact step-by-step process that we've used to buy over $100 million worth of property in today's market. We've built Australia's largest property investment community with over 80,000 members, and we help everyday investors secure hundreds of thousands of dollars in equity, all without wasting years of their life trying to figure it out the hard way. Making an uneducated decision on the biggest purchase in your life is just gambling with your future.
Stop it. Get some help.
And this isn't just another how to buy property course. Let's be clear though, this course isn't free. What? And neither should it be. This is our life's work. We've spent over 100 hours each on this course alone. Oh, babe. Okay, video number 3. Number 4 with million does... Done. We've got decades of experience, millions of dollars in deals distilled into a repeatable process that you can take away for yourself. If you're looking for free advice, there's plenty of noise out there. You can go and find that if you'd like. But if you want real, actionable, step-by-step guided process that works in today's market, then this investment is going to change everything for you. By the time that you finish this course, you will have full confidence. You'll have every tool that you need to build an amazing portfolio if you act on it, right? Which is why we have mentoring built in. So we kick you up the butt to make sure that you're kicking your goals. So the real question is, how much longer are you going to watch everyone else making money in property before you jump in and start playing the property game properly? Because the sooner you start, the sooner you start winning.
Yeah, there we go. That is one.
Who's
That is one.
These ad breaks? Need to give them a pay rise.
Yeah, lots of people. But yeah, some creative geniuses from all around, including your team, Joe. So I wanted to before we go into anything too alternative, were there anything, I suppose, around property that's exciting that everything around property is largely exciting, a property tax strategy that you really think we need to know or think about?
That we haven't touched on.
Yeah. So I was just thinking about that during the break. Then one thing that people often struggle with is they compare themselves to those that went from, like, some of the headlines you guys have had, from Macca's to 9 million property portfolio, those sorts of things. And they get stuck in the thought process that I can't do that. I don't have the skills to do that. I don't have the capital behind me. But the people that don't do anything will always have nothing. So it's about getting out of your comfort zone, just thinking differently, and just starting to take steps to push yourself towards the goal. And it's gonna feel uncomfortable, but there's one of my favorite sayings is, if you're not uncomfortable, you're not growing. So if you're just cruising through life and you're doing the same thing at work, and you're going to be the person that just gets the 2-3% pay rise, but if you're the one that's putting yourself in situations where you're learning new things, you're challenging yourself, you're going door knocking if you're an estate agent or a buyer's agent, or if you're looking to promote your gym or whatever it is, if you're not getting yourself out there and interacting and putting yourself in different situations, then you're not going to be the person that's got a $9 million portfolio at 25 or 45 or whatever age it is. So I think the mindset and the psychology behind it is something that definitely holds people back.
Yeah. I think a big part is surrounding yourself with people that are doing, not necessarily have done the thing that you want, but are in the process of doing the thing that you want. Like Jeff and I, you caught up before we had many moons ago, before we even started investing in property, and we just kept egging each other on. What are you doing? How's it going? What's happening? What's going on? Where are you at? What's going on? Property. We should make a podcast. Oh yeah, let's make a podcast. Oh yeah, and let's do it every single week. And now we talk. But it's kind of it aligns where you're going. Like whoever you surround yourself with, you become the five. Really, you hear it all the time, the five averages.
Right,
but if everyone's headed in that direction around you, you become a little bit normalized, not idolized, and you'll start to see, oh, actually, that guy's 3 steps ahead of me. That's what I really like, is not seeing, the person that's got 50 steps ahead that bought 15 years ago. I'm more interested in the guy that started buying 2 years ago, 3 years ago, 1 year ago. Like that guy or girl, how do I get, because they just went through what I'm about to go through if I'm just starting out. So that's, exactly. I love that. But yeah.
And what you guys have done, like building your network of 84,000 people, is there's so many people that have been through that already that are still going through it, and people that will go through the first property, the 10th property. And it's unbelievable how much people give back to you, and how your goal then becomes their goal as well. They help you, they guide you, they might refer you to a professional, they might say, I've got a good broker or accountant or solicitor that is really good at conveyancing, or they might be focused on doing subdivisions for the larger properties, and people help each other. So it's about, I think, like you've touched on, finding your tribe, finding the people that you can lean on and learn from.
Yeah. And have that inbuilt accountability as well, if you can, like not necessarily using it as a clutch, because like if there's somebody out there, I mean, I put my hand up for this in whatever sort of capacity. I mean, even if it's like a fitness capacity, like with a mate now, I don't do it every day, but literally I'm taking like photos of me doing my foam roller with a mate, just because it's like, okay, what are we doing to move forward our goals? Like, and if like, some people will just, you try doing that with them and they'll sort of laugh at you every day. But it's how do you, because it's like, well, but then, and that's, as to Robbie's point, it's like, where is that the tribe? Because the people that are on the same similar path won't laugh at you. They'll be like, wow, that's really cool. There's somebody like me. And maybe that's, I don't know, grooming as many dogs as you can. I don't know, like whatever the thing you're involved in or interested in. I think that's important.
Yeah, exactly.
Love it. I'm interested in alternative assets. And for property investors, when do you see people getting into alternative? Because the problem with property is you need a massive deposit. You need $150,000 to kind of get in to start. So that's tough to be able to have that amount of money to get that deposit going. Like, and then you're building the portfolio and you're trying to use all the equity to buy another one to build the portfolio, and then you don't really have excess capital. But how do you think about commodities and gold and silver and copper and rocks? Like, what the hell is this thing?
Yeah, that's uranium. Uranium.
Oh, URA. There we go.
Yeah. So it's something I've been quietly researching for probably 5 months or so now.
Yeah.
So going back a few steps, I sold everything. I sold my bike, sold a car, got everything out to buy into the market, and the last sort of 4 years, upsized house. So started again essentially, and maxed out the loan to buy our family home. And I've gone through the stage of saying, well, at the moment I can save a little bit, but saving is not going to make me rich. What can I do instead as an alternative? What fits my risk profile? And am I willing to put it into the stock market in some capacity? So I've listened to like webinars and stuff like this, people chatting, gone to a couple of training sessions, and I've always had a passion for, I guess, helping people with money and wanting to do more with mine. So I've personally recently, going back to last July, I've invested in ETFs and some single shareholdings in the commodity space.
I hope you bought a silver ETF, because I hear about every 3 or 4 days. Oh, it's hit a new all time, and I'm like, this is in like a non-property group that I'm in, and it's not a commodities group. They're rotating. Sorry.
Yeah, sorry, Jay.
No.
I found it interesting that someone was commenting on the build up to tonight's session, asking about commodities, and I know there's sort of mixed views between people as to whether they're purely property based, if they're a mix, if they're purely not property. What I see with my clients at work is they generally have a mix, whether that's your long-term set and forget super fund and it's just in the share market, and then you've got property in your personal names and in trusts, or whether it's a combination of both. There's lots of different ways to build wealth. There's lots of different ways to build income. There's not one size fits all approach. So I think, similar to a diet, my grandfather was always saying to me, moderation is key. Don't cut out alcohol because you think it's bad. Have a drink once a week. Don't think chocolate's bad because it's got sugar. Just have a couple of squares, or try not to eat a whole block in one sitting. But everything in moderation. So I think if you use that same approach for investing, there is space for alternative asset classes, whether it's people that are actively managing, they're looking for the next opportunity in the small cap space, whether it's an exchange traded funds that's a basket of the top 200 companies, or if there's a particular thematic approach where it might be my recent ones, which are commodity backed ones. Whether you're just looking for a top shelf company like BHP that's just regained the top position as the biggest market cap company in Australia. So there's lots of different ways you can approach things. The risk is if you're saving for a deposit, you kind of need to think, how long is it going to take me to save 100 grand? If it's more like 5 to 7 years, then the chances of investing in the share market and having a downturn in 5 to 7 years, there's always a risk, but the chances of your portfolio growing over 5 to 7 years is pretty good chance, right? So if you're looking to put down a deposit in a year or two, you might be less inclined to put money into the stock market because there might be another Trump post, or there might be another COVID event, and as you're about to pull a trigger, you might lose some deposit. But just like property generally goes up like this. If you look at the All Ordinaries Index and the S&P 500, it generally goes like this. When you zoom in, sure, there's lots of ups and downs, just like in different locations in Australia, there's mining booms, property goes up, there's new suburbs being released, there's new influx of people and that sort of thing, and different pockets go up and might not do much for a little bit, and there might be another one that shoots right up. And so that just like the cycles work in the property market, the same thing happens with the stock market. And all the sort of research I've been doing lately sort of indicates we're at the early stage of a commodity boom again. So I think 2010 was
the early stages of the commodity boom.
Yeah,
the early stages. Over the past 4 weeks, if you bought silver, you would have outshone Ethereum that you owned for the past 4 years. Like,
it's
crypto,
mate. Crypto, Joe. I know about our crypto. Yeah.
There's plenty of people have made millions. Plenty of people made millions in crypto as well. Like, you just have to be one. You have to take a risk, and you have to have the timing right. So you're never going to know if the timing's right or not. And like we just touched on, gold just hit like an all-time high. I think it's like $5,200 an ounce. And I had to Google how much an ounce was to sort of relate the price to the volume of the gold, and it's like 28 grams. So it's not a huge amount of gold really, but it's like I don't know, 8,000 Aussie dollars maybe. I can't. Not sure what the conversion is.
The only thing that concerns me about some of that thesis is, and you sort of, and in property it happens to some extent, is you start to see people lining up outside of like bullion places to buy that physical thing, and I'm like, it's like it reminds me of the taxi driver or the Uber driver these days. You get in there, it's like, oh, what are you buying? I'm buying some gold and silver. It's like, oh, okay, all right. That's and I'm not saying that will happen, but I'm just saying it's kind of like a little bit of an amber flag for me to consider investing in that type of.
100%.
But yeah, I don't know.
So
I don't know about it.
I agree to an extent. I still think there's going to be more growth, but what you're talking about. So do you remember Afterpay?
Oh yeah.
Shot up to $250 a share or something, and then dropped. I don't know what it is now, $190, whatever it is.
Yeah.
A lot of people were talking about it, and people had FOMO. Like, I know someone who's an arborist, and they were saying you've got to buy Afterpay shares, and I'm like,
goodness me.
Like, I work in tax, and I have a financial wealth management company that's in the same office, and I'm like, not everyone's talking about Afterpay at work, but once there is that mainstream chatter about a particular thing, people start having FOMO and they start pushing the price up. And then there's a point where the people that have got in early start taking profits, and there's either a sharp drop that resets the value of the company, or it can potentially just keep going. So if you look at the charts, and if you put it on a monthly basis, silver did nothing since 1980, basically. Same as gold, hasn't done much. It's basically just, I think end of last year, it's just took over like inflation, basically. So it's just held value, done nothing for decades, and then it's just gone like that. So when you look at it, it's pretty scary. It's like almost a straight line.
Why did it do that? Why gold and silver? Like, what's this situation?
Yeah,
like, what's the actual intrinsic value of it?
I think it's a number of reasons.
Like safety, basically. Some extent.
I think it's a combination of a couple of things. So there's a lot of uncertainty globally. You've got, Ukraine, Russia, been going on for 2 years or something. You've got like Iran. I saw something today. They were saying if that, whatever the big naval ship is, if they start getting too close to Iran, they've threatened they're going to sink it. So there's all this like unrest in nations. You've got, Palestine and stuff going on. So a lot of people they're just going to a safe haven asset, something that just stores value, and people are stockpiling gold. Like, I think China and India are stockpiling a stack of gold as well. So people are just flocking to it, like, and not just people, like governments and countries. And like I was in the city, like Martin Place in Sydney, couple of months ago, and there was like 50 people lined up outside ABC Bullion waiting to get in the doors and buy some. So when you get to those stages where, like you mentioned, your Uber driver, you're having a barbecue and people are talking about things, sometimes it can be a sign that you've gone from the accumulation to public participation, and then it's the excess phase, and you might be toward the top, and then that's when it generally resets. But I think it's still really early in the piece. I don't invest based on what my gut tells me, but do your own research. But I think there's still some to come. There's probably going to be a drop before it goes up again. But yeah, there's plenty of options to look at.
Yeah. So I guess from a like a practical accounting side of things, the way I'm kind of thinking about this is alternative assets. So property is the main vehicle, right? We can leverage property. We can have $100,000 to buy an $800,000 asset, and that 100,000 doesn't grow at 5%. The property grows at $800,000 at 5%, which gives you an exponent. Well, not an exponential. It's 8x return, right? On that. Yeah. So like that's kind of very interesting, but it sounds like the beginning phase of when you've got your deposit where you're saving for the deposit, it might be worthwhile because the bank's giving you a 3% saving rate. You don't have an offset account. You can't do anything with it. That might be an interesting time when to explore shares and things, but it sounds like it might be just more of a safer asset, like an index fund. Then when you're building the portfolio, you're not going to have much capital, right? Where you're buying property 1, 2, 3, you're not going to have that much excess capital to be able to do it. However, I can see another window of opportunity where you can then say, okay, well, I've got all of these properties. I can borrow $200,000. I can go to the bank and say, hey, Mr. Bank, I want $200,000. And then the question is, if I have this $200,000 in my offset, I'm guaranteed 5%. Right, 5.6%, what my mortgage is, because the money's offset. Do I think I can get a better return by investing in something else like shares, crypto, whatever? And that's your decision to make. But that's where there might be an opportunity to use your borrowing ability to be able to then say, well, I know I'm going to get 8, 9, 10%. And then use that, get your thing, build up an asset base to, improve your borrowing ability to then go for the next property in 2, 3, 4, 5 years, if that's your thing. Because if you're not buying if you're not going to buy another property, then you're paying down your portfolio. Every piece of debt that you have that you can use to go into something can be used to go into other assets because it's just a guarantee of 5.6%. Does that sound? What are your thoughts, Jeff? Jeff is shaking. What's your thoughts on that, Jeff?
Are you saying that you're saying that if you're not going to buy more property, if you're paying down debt, maybe you can reallocate some of those funds after you paid it down to then buy a different type of asset? Is that what?
Yeah,
that's what I was.
Yeah, I mean, you've got the capacity there, you've got the capital there. You're guaranteed your mortgage repayment, but you're not guaranteed. You might be able to get a better return because you know how to invest better. But the bank won't lend you a $600,000 loan; they'll only lend you $200,000. So, and know that's not going to change in the next 3 years because my job's going to change. Hey, let's take that debt, put it into an asset that's going to grow better.
Yeah.
What are your thoughts on that, Robbie?
Yeah. So, speaking from my personal journey with investing, I've been in silver since last August, September, and again earlier this month. Like just today alone, I think it went up. The ETF that I've got that's tracking the price of silver went up like 4% just today. So it's growing. I've got other ETFs that have gone up 30%, some are 60%. The silver one on average is about 110%, but my first investment's like 160% increase. So I've got significant growth, but my goal is still, I've got some risky like individual companies I'm looking at where they might be worth 10 cents a share, and I'm hoping it'll go to 15 or 20, and I'll get a really heavy decent return, and I might put say $500 in that, and then I might put $500 in an ETF, which is a little bit more diversified. There might be 20 companies that are in a certain commodity space, for example. I've got like copper plays, silver, gold, etc. And they're growing quite a lot at the moment. My risk radar is sort of saying at some point this is going to come down and it's going to be a bit of a shock to sort of go through that first move down, but I still think there's a long-term future there. But my goal is to have a risky, high return position, to have a bit more of a diversified, safer ETF-based approach, to then build up enough money to then look at leveraging and going into property and looking at that ultimate big return of 100,000 deposit, 600,000 property goes up 10%. Well, you've made 60 grand on a property that, if you're in the share market, you're going to be very lucky to return that on a sort of average of a 10% return, like the S&P 500 or what the ASX 200 did last year. So yeah, that's the goal for me, is to build capital. It's happening quite quickly at the moment, but it is a long-term thing, and I think property generally should be as well. You're looking at the cycles. Some people talk about the 18-year cycle, the 7-year cycle, that sort of thing. So,
7 years. Interesting. I don't know about this 7 year. I mean, 7 to 10 years, maybe. I mean, we had Akhil Patel on to talk about that 18.6 year cycle. And it's just interesting to sort of hear the perspective. I think that's more about a general global economic, which may apply to some parts of property, which I don't know, because if that's 18.6 year cycle is going to happen in property, I think it'd be an interesting one.
There's talk about it's whether it happens. So I'm a little bit skeptical with looking at those charts that have like a little wave and a big wave, and 2026 is the wave of property boom essentially, and they think it's going to be the peak in the market. But like it's so set out, it doesn't factor in, the adoption of AI that's been happening. It doesn't factor in all the wars and unrest around the world. So it's hard to make decisions based off some squiggly lines that someone's put in a graph. But if history repeats, then it's going to happen at some point. It might just be a few years off. You never know. So, yeah, there's always that risk of being right, having your timing wrong. You just got to work out what your tolerance is, I guess.
Yeah.
There we go.
Yeah. It sounds like it's there's a space for it. There's a space for there's space for any investing as well. It's like you can make money in, random stuff. I see people going to charity shops and flipping stuff on Marketplace, right?
Yeah, exactly.
But that takes a little bit, but that takes a lot of time, energy, and effort. But do whatever you can to build that portfolio. Mate, this has been an incredible session. I've enjoyed this from a mindset perspective, and also like opening up, just thinking of, that thought I just had around, oh great, well you could use equity to, potentially buy shares or crypto or whatever, because you might be able to, that might actually be a good idea. It might be able to buy some copper. I know there's a lot of places where people just steal a lot of copper. So, there's a market for it.
That's it. The tradies are knocking off all the wire from the jobs and
actually one question I do have is you're investing in gold and silver. Do you actually just have a block of silver at home? Like you just got a block?
Nobody.
So on that note, actually,
yeah, but then why is everyone going to the mint? Why is everyone lined up at the bloody thing? They're not doing that to get a digital product, are they?
There's a couple of people that believe that the actual tangible gold and tangible silver is the only way to invest in gold and silver. Yeah. But there's actually some ETFs that they basically acquire a percentage of whatever investment you have, and they store it for you, and you can convert it. So there's an ETF, I think it's based in Perth, Mint, PM Gold. So you can buy into that ETF, and you can exchange it for gold if you want. And there's one, I think, that silver as well. But on that, so going back to that debt recycling situation, if you're looking to invest in gold and silver, it doesn't generate income. So the growth has been astronomical the last 6-8 months or whatever. It sort of started taking off. But that interest, if you're borrowing to invest, not only is it risky in the first place to do that, but there's no income from that. So the interest isn't deductible. Whereas if you're investing in, say, the top 200 companies in Australia, most of them pay dividends. So there's that nexus between the income producing investment and the interest. So you can claim a deduction for that. So it's always a consideration. And then you got to think about whose name you're going to invest in. You're not going to get. It's generally, if you're looking at a short-term investment where it's shot up from $20 not too long ago to over 100.
Maybe consider your exposure to that asset and considering what the exit strategy is or was.
That's right. You got to be happy. You got to set a, if I double my money, I might take out my initial investment, leave the rest in. It's a common approach with crypto. They might put in $5,000. If it doubles, great. If it goes up 5x, they might take out their 5 and they'll just leave the rest. So yeah, there's lots of different approaches, and you just got to work out what you can stomach and what's going to help you sleep at night.
Yeah. Look, before we this has been a great session. The thing I love is that we've got contrasting views and just some healthy discussion here about how to build the Go from beginner. So drop us a 5-star on Spotify team. I'm going to see if we can get us to 100. We're getting closer. We're on 44, 45. So get us there, and that helps us to get more exposure, because I want us to take over the property investing waves and get up the charts on. Not that I look at the charts anyway, but no, it's been a great session, and thank you for coming on as well, Robbie and Joe. You take us out.
How do we get more Robbie in our life, and what's Save Our Budget? Can you give us a bit of a breakdown of like that, and how we can learn more about and get more Robbie?
Yeah, sure. So Save Our Budget it's a side gig my wife and I set up. Basically, because we're both passionate about helping people. So my wife's a nurse. She's very organized. She plans a lot of things. I'm more the number cruncher, spreadsheet sort of guy. But I started my career in bankruptcy and insolvency, and I saw people that would waste money, get into issues with debt, having to file for bankruptcy, companies that weren't doing well. They're borrowing money against their house to try to keep their company afloat. So I've seen what not to do with money, and I've kind of seen the other side where clients are successful in business, investing, whatever it is. And so I guess it's just a combination of what I see as a professional and trying to help guide people as a family unit. So we touch on things like the psychology, the goals, wants, needs, all that sort of stuff. Thinking about how to set yourself up for your kids' future so that you have a house over your head, whether you're looking to save for an education for your kids after high school, all that sort of thing. And then talking about things like, speak to your mortgage broker, make sure that you're having your rates reviewed frequently, you've got the best deal. Topics like estate planning. Have you got a will? Like if you've got one kid and you're looking to have 2 or 3, maybe wait. And then when you've finished, maybe look at going and getting a SNP, because kids are expensive.
Yeah, we've got proper life planning.
And you don't want surprises if you're not ready for this. So things like that. And then
that's funny. Yeah, I had a client come to me.
It's just basically.
He's like, sorry. Yes, that's awesome. I mean, it's fundamentals and foundational finance strategies that you need to get set up and think about. Mate, unreal session. Jeff, anything else you wanted to cover off?
I think I'm good. I'm going to go and do lots of things and get fired up. Take action. That's what we're all about.
Let's do it. Let's go buy a property,
Robbie.
guys. See you later.
Exactly right.
Thanks, Robbie.
Thanks a lot, guys. Appreciate it.